And we're excited now to move into the first panel of this conference. And who better to kick this off for us to help you learn how to secure investments and raise funds during this challenging time. But it's led by one of the most active investors in North Carolina. It's David Gardner from Cofounders Capital, headquartered in Cary. And David has an all-star and a very diverse set of investing experts, starring Ellaine from RTP Capital. We have Keith of Resilient Ventures, Suresh from Samma Capital, and Monique from Mucker Capital. So I'm going to turn it over to David. We're super excited for this panel to help you all who are in need of funds to raise capital successfully. David, thank you for leading this. It's all yours.
And thank you, panelists, for being here and giving us some good advice today. Do we have all of the panelists?
We're here. I don't think our video's all on.
Yeah, I just
there we go.
But this keep.
All right, I think we've got everyone but Ellaine.
I'm here.
Yeah, Ellaine just spoke up.
There you go.
Here we go. My video wouldn't start.
And we're all here. So we're talking about how to thrive during the pandemic and shutdown and how to have the best third and fourth quarters ever. And you are the guys that are writing checks. Angel investor groups, venture capital groups represent a lot of different things, from CPG products to software companies, B2B. Monica does B2C as well. So lots of cool stuff. Suresh has an international perspective on things with many investments in India as well. So let's start off. Are investors writing checks today? When was the last time that your organization wrote a check? Let's start with Keith there at Resilient Ventures.
Well, good afternoon, everyone. Again, my name is Keith Daniel. Thanks, David. I had a feeling you were going to call on me first. I don't quite honestly consider myself an expert in this field by any means. I see a few founders on this great summit experience who we've had a chance to interact with. We've been in this business 18 months. My co-general partner and I, Tom, and we're learning from you guys. And you know that we've reached out, try to understand what's really happening. How do we manage our unique thesis? We're seeking, in particular, African-American founders, early stage. We're fortunate we are going to make at least two investments and probably one co-investment. And we increased our total limited partner pool by 4 or 5. And then we had a few who increased their committed capital to us. So yeah, in some ways, yes, but we felt like we were further along the track before COVID hit, but checks are being written.
Okay. And Suresh, how about your organization?
Actually, we've been fairly active. We just made a new investment 2 weeks ago, and we're signing one today with funding next week. I think we've made 3 investments that are, I would say, post-COVID, meaning post-March. So, yeah, we have capital, and as long as we see great opportunities, I don't think we're going to let the environment stop us. Again, all of us here are investors for the long term. So we have to look beyond the next 6 or 12 months of turmoil and look at what, these companies and entrepreneurs can build in the next, 3 to 5 years.
So is that regular pace? Do you feel like you're at the regular pace that you would have been on pre-pandemic? And you're reading that there are 35% less checks being written today than were anticipated. I know we're writing checks at co-founders, but unfortunately, most of those are going into our existing portfolio companies. Is this on par with what you anticipated doing this year?
Yeah, we're on a pace of 4 to 6 new investments a year. I think by the end of next week, we would have done 5. There's no shortage of checks going into the existing companies. So, that is par for the course, especially as an early stage investor. And, some of these were unexpected due to the circumstances, companies needing money, in advance of when the original business plan had them requiring it. But that's part of the business. We have to roll with it as investors the same way as the entrepreneurs are rolling with it on a day-to-day basis.
Monique, how about your organization?
Yeah, so I'd say that we are on pace, same that we would be for 2020. I'd say that I completely agree. Our game is a long game, and so we're really thinking, from a 10-year fund perspective, that a month or even a year plus long period in the market really just exposes where there might be new opportunities in this kind of new normal that we're facing. And we're seeing significant growth in certain categories, including e-commerce, health, obviously, consumers being completely reimagined in terms of, what that looks like, shopping, what does shopping look like? What do financial services and healthcare look like? What does software look like for companies? We just signed a term sheet yesterday for an Atlanta-based company where we'll be writing a $4 million check. So very happy about that. We are probably at about 15 new investments since March. So it's definitely been a healthy pace between our pre-seed, seed, and Series A checks that we've been writing.
Yeah. Ellaine, how are the angels writing checks?
The angels are writing checks. We had probably a slowdown in March. We wrote a couple of checks last week, in fact, week before last, and then we are getting ready to invest in a couple new deals in the next coming weeks. And the interesting difference we've seen, like you said, David, a lot of our deals, I'd say April through July, August, early August, were follow-on deals. Much more appetite for seeing the follow-on checks, people raising more money to ride out the pandemic. We're seeing a lot more interest now in newer companies, and the two I'm talking about coming up will be new deals. We've seen, the good news is all of our companies, our portfolio is all operating. Several got PPP loans, and we have several that are really capitalized. We have a fair number of healthcare IT companies or healthcare related companies, and they've been able to really use the pandemic as an opportunity to grow and accelerate their businesses. And again, I'll put on my other hat, which is Angel Capital Association broadly, and we're seeing the same trends. More interested in follow-on, but there is the appetite to invest because people do see the long-term opportunities.
So how are your investment thesis changing? Is this situation causing you to look at things differently? I know we had a strategy session at Co-Founders last week to talk about preparing for our next fund. And what would the thesis be? Our thesis has been focused on North Carolina companies. Well, now every company seems to be virtual. It's kind of like redefining what is a North Carolina company now, when no one actually has a physical office much. And so let's go back to Monique. What about Mucker?
So I'd say that our thesis has always been to work with founders with a unique insight at the earliest stages of company building. And so that unique insight is something that continues today. So I'd say that's pretty steadfast for us. In terms of evaluating stage of the company, capital efficiency, and really having something where what we call destiny control, that with our investment, they'll be able to still have some control of their destiny as a company, even if they weren't able to raise more funding on sort of the more traditional timeline that they might have thought about otherwise. I'd say that we've always approached our investments from that lens, and it really applies in this COVID era, right? Because the capital efficiency, the stress testing, from a go-to-market standpoint, your buyers have no time for you if you're not creating value for them. And so it's really testing sales and marketing strategies is what we're seeing. And so those are the types of things I think have always been a part of our thesis, but it's sort of doubling down on those in this climate.
Suresh?
I don't think there's been any change from our standpoint. We're fairly diversified. We make investments across industries, both tech and non-tech. Everything that we do has an India connection. But again, with that wide lens, there's plenty of opportunities, that, we will continue to look at and focus on.
Keith, any changes in your thesis thinking?
Yeah, again, as an early first fund, we had to, question our interpretation of our field of founders that we had engaged with in terms of their resilience to the pandemic, or how the pandemic would actually affect their business solution or the market that they were in. We entered the space with a disposition to be relatively agnostic. Our first 4 deals, 2 of them were SaaS-based, 1 consumer products, and 1 was Main Street. We still are planning to stick to our game plan as it relates to that, while also trying to really understand the larger market systemic realities for certain sectors. We decided we were gonna, the one thing we did, as we considered our own kind of quote unquote superpowers, my colleague, general partner, he's spent 3 decades in computer software, and he's a full stack developer. Obviously there's an inclination around the tech and tech enabled. And so one of the deals we're looking at this year, really attractive out of Atlanta, with that resilient factor in terms of how they've already kind of been at it for a while, but are ready to go to the next level. And then we looked at a co-investment, and we're actually excited about that outside of our space a little bit, but because the lead has some strong competencies and we have some trust level there that's built, we feel like we can do a co-investment in that. Overall for us, our name is Resilient Ventures, and I was listening to the speaker before, and when we find the right people and the solution, we may still be trying to understand the space again early on, whether we feel like we have enough knowledge base or what value we can bring. But at the end of the day, it's finding the right people. And you kind of, in my experience, when I found them, I've known pretty good in my gut who they are, and then we try to ride the storm with our founders, because yet again, our thesis principally is that there are more African-American high growth founders out there than are getting the attention they need. So we're going to stick to it and try to bring them to the front.
Well, for what it's worth, Keith, Resilient turned out to be a great name. So, is it harder for entrepreneurs to get funding today than previously? Intuitively, you say, yes, I talk to entrepreneurs and they go, oh, we're delaying our raise, or we're going to do another friends and family round because we think money's too hard to get right now. Excuse me. But then I talk to venture capitalists and they go, oh, we're writing checks. The best companies, there's always money for the best companies. Is it that there's not funding available for early stage companies, or is it just the entrepreneurs think there's not money available now for early stage companies? Ellaine?
I think it's the latter. I think that they're afraid that there's not the money there when there really is. We are seeing 30 to 40 companies we're screening each month. We're really doing a lot, bringing them in. I think the real difference for our group is that they want to see a little bit more traction. So if you are just at the beginning concept stage, yeah, it's probably going to take you a little bit longer. But if you've begun to get any type of traction, it doesn't necessarily have to be revenue. The interest is clearly there because people recognize this is the time to get in. You can probably get valuations will be slightly lower from an investor point of view. So that might be why the entrepreneur wants to wait. But for us, it's a good deal. You could get more talent. Everything's being done virtually. So the typical thing about the SaaS company, we used to fly all over to try to get these enterprise deals. Now they don't have any travel expense. So they can manage their cash a lot better. So I think the entrepreneurs can find the money and they can build more quickly right now.
Right. Suresh, how about you?
The capital's there. There is ample liquidity in the market. If you just take a look at across angel groups, across institutional firms, there's no shortage of capital. I think part of it is time. There is more time being dedicated to existing portfolio companies. You're more worried about where your money is already as opposed to where it's going. But that doesn't mean that there aren't checks being written. I mean, I think all of us are on a fairly steady pace. So, I think, maybe not having your story right or not having the, fundraise go the way you expect, maybe the easy way out is saying, people aren't writing checks when that's not actually the case. I think I think it's harder when you can't meet people in person and build that conviction on the entrepreneur. So I think that's one thing that is affecting all of us. You have to have a much higher level of confidence that this is somebody that you want to back and they can build something of consequence. I think the other thing is, again, there is turmoil. How do you get to your customers? If your enterprise sales process takes 3 to 6 months and you can't meet them in person, very tough to get people across the finish line to write you a check as a customer. So there are these other things that do factor into how difficult it is for the entrepreneurs. I mean, it's never easy. These times only make it more difficult, but the money is still flowing as we all can see.
David, if I can build on what Suresh is saying, and I'm going to come back to Keith's point about resilient ventures. What we're seeing here is the really strong entrepreneur is able to make these things work. I want to facetiously say, what we're looking for now are more limbo players. You've got to be able to be flexible. You've got to be able to turn. And the really great young in terms of experience, not age, entrepreneurs are really showing their stuff. I'm sure you're seeing it because you see so many, early, just first round entrepreneurs. They are really demonstrating, I can figure out how to get there quickly.
So we've kind of seen a rebound in the last 60 days or so in some of our companies that were struggling, and it feels like things are turning now. Let me ask you guys, are you seeing which of your portfolio companies are doing well or have thrived during this time, and which ones have been hit unusually hard? And is that changing how you think about deploying your dollars right now? Let's go to Monique.
Yeah, so we've seen, I was mentioning a little bit on the e-commerce side, we've seen companies accelerate because, merchants that might have relied a bit more on in-person or brick and mortar touch points with their customers are having to innovate and find a way to really connect with customers online. And I'd say that we've seen some really strong growth in that capacity. Anything that enables workflow remotely is doing extremely well. We have a company that does outsourced HR, and they've been just skyrocketing because they have a really user-friendly price point and have a human curated level of HR support for businesses of all sizes. So they've been hiring, they can't possibly hire enough people. They just keep hiring more and more people. These companies need that HR support through this time, as we all know. So I'd say that overall, anything that's, again, delivering very genuine value to the end customer will do well during this time. I'd say that other categories, like we're seeing somewhat in healthcare, I think that in-person visits have been impacted. Hospital revenue, bottom line has been needing to be scrutinized. There's so many elements that I think if you're selling in a product or service that's more geared around sort of the in-person interaction, and it's not of critical importance right now to the healthcare community, those sales cycles are getting pushed out a bit. And so what we've been seeing is, founders who are able to turn on a dime and think about, okay, how else can we creatively use this technology to really deliver value? And that's something that's not just in the short term, they're going to need to do that in the long term. But we've seen, to your point, our companies rebounded, I'd say, by June. Another really interesting space is real estate. Houses are flying off the market. There's so many opportunities to equip both the buyer and the seller and all of the people that help to get a transaction through. So we're seeing a lot of growth there. But in March and April, they saw zeros. This was like, no one was going to do anything in March or April. And then by June, it was like they were back where they were, and now they're past that. So it's been a ride for everybody. And I think that investors, again, the more we can think about sort of the end goal and the long-term view, the more conviction we'll have to really get behind these founders and support them.
So one follow-up question, Monique, who's been impacted more, your B2B side of your portfolio or the B2C?
That's a good question. We're pretty evenly split between consumer and enterprise-facing companies. I'd say that it depends entirely on category. So for healthcare, for example, I'd say B2B, they took a hit and now they're getting creative and making things work. I'd say it's a lot more successful to actually equip more of the private practices and kind of smaller groups than it is the larger health systems and hospitals, because they have so much to deal with, whereas the small practices are really trying to innovate around their workflow. So we've seen some companies get some success actually going down market a little bit more in healthcare. Consumer, I'd say that travel has obviously been hit, but at the same time, products that make people feel great about being home and, they can buy for themselves to reward themselves because maybe they're not traveling or they're not seeing their friends or family. There's a lot of like housewares, and beauty has been really taking off. For example, people really taking care of themselves, their skin. It's really all over the map. We have a very diverse portfolio, so I feel like I could talk about this topic for way too long.
Thank you. So, Suresh, I'm curious at Samma Capital, you have invested a lot in consumer products and CPG brands. And I would imagine that they have actually may have even been helped through this time, as that the restaurant spend has kind of moved to grocery store spend. So, are any of your CPG investments actually doing better than you anticipated?
Actually, they bounced back tremendously well. India went through all of our consumer investments are in India, and as India went into a lockdown, starting in the middle of March, like Monique had talked about, there were a lot of zeros on the board when it came to the revenue line, and once you kind of got through that period, you saw online pick up dramatically, and there was this bounce back that was far exceeded what we would have expected. In most cases, they're probably back to 75+% of where they were. I don't know whether anybody's exceeded where they were, but they did take their cost bases down significantly, through salary reductions and layoffs and so on. So even at 75% of where they were, they became profitable with no marketing spend. So it was pretty dramatic what happened. And I think the companies that we back on the consumer side, and particularly on the branded consumer side, are really targeting middle class and upper middle class. So, when you hear about, India's economy contracting 25% and, issues on a macro level, when you go down to the salary classes, they still have money. They still are quite comfortable buying online. There is a strong element of retail therapy. When you're locked down, you are going to go and buy things to make yourself feel better and, help yourself out mentally. So we've seen all of that. And it has been, quite a significant rebound in a very, very short period of time.
So, Keith, a little different question. Having lived through the last, 7 months, has it changed? Are some industries now more attractive to you and some less attractive, having lived through what we've gone through in the last few months?
As I say, with us starting out, we had to think critically about what we felt like our best value could be added to our prospective companies. Again, we've made 4 deals. One was, in fact, an HR based solution. So that's exciting. I mean, my career has been principally in higher education, leadership, management development, I call it people building capacity. So I believe those are always winners if they have that unique sauce to them. So certainly have an appetite around what I call any human capacity engineering, any kind of solution around that, and innovation and making people better. Again, this is a time where we got to figure out how do we be better people as well as we try to deal with the economic realities. And trust me, better people we need. As far as, so ed tech as well. We were excited to write our first check this year to an ed tech company, and they're just exploding. It's fascinating. It's fun to watch. And I still do some ed tech work for Duke. Or I'm in well, it went more virtual. We were on campus the last 30 years. So certainly that is good. We have a consumer packaged good or consumer good based company that kind of took a blow because production was affected both from global standpoint and readiness, but it's a resilient company, and they've figured out how to remain lean and be, stay in the game. And I think they're prime. They just had some new milestones to emerge, but obviously if the space is already crowded around consumer packaged goods and things like that, you have a problem. The last thing is we want to make at least one investment a year on Main Street. And that became really challenging. I mean, again, in this case, we had some investors that were excited about that until this happened. They were already saying, why would your portfolio commit to that, given that the history of Main Street or lifestyle businesses aren't going to really provide those returns. But in this case, it's a great founder, and it has a great vision. And we're excited to see that vision still persist while others have been unfortunately flooded out and have had to close operations, like you say, again, if it's brick and mortar or something to that effect. Yeah, so for us, I think, given we're still yet early and we've had these, what we feel like our wins, again, we have no exits yet. So that's why I say I'm not the expert, but I do feel like we're developing a greater acumen around what fits our competencies best. How can we ride closely with our companies, and still trying to stay fairly diverse and not be scared away by anything unless it's clearly not going to be able to survive the conditions.
So Ellaine, saying a little variation on the same question, maybe just not only what industries, but maybe which go-to-market strategies have you? I know for me, it's not so much the industries that are changing as I'm looking more critically now at the go-to-market strategy. For example, if most of a company's leads are coming from big trade shows, whoa, that's a big red flag to me right now, So what, is it industries or go-to-market strategies that have changed in your thinking?
I think it's the ability to respond to the changing environment. So we have a product where my portfolio had primarily being sold through gynecologist recommendations. Well, but the product was technically an OTC product, so you could basically buy it. Totally switched to e-commerce. Their cost of sales went down. They've blown through all of their revenue forecasts. They've grown tremendously. Able to change how they went to market, be flexible to a new need. On the other hand, you've got a company like Seal the Seasons. Traditional CPG, it's frozen fruit. But because people are at home, they're cooking more, they're doubling their sales. So I think it really depends on, to this point, coming back, does the entrepreneur know how to adapt? We have a company in the med device space that really deals with respiratory issues.
Mm-hmm.
They were going to be doing a very slow roll to build. Well, suddenly they're trying to do all these clinical trials related to COVID, and they have the ability to monitor things remotely. So they are growing tremendously. So it's figuring out being nimble rather than an absolute market strategy.
So guys, we have about 60 seconds left. So I'd like each person to take 10 seconds. How are you helping your companies raise capital right now, or advice that you have for them in raising capital? Let's start with Suresh.
I think, our message is try and control your own destiny with the cash that you have. Be very conservative on revenues, control the expenses, and try and make the cash last.
Got it. Monique?
Destiny control is a big part of it, but I think in terms of fundraising, we're doing extra legwork to really build those targeted lists and talk to fewer investors, which seems kind of against the grain, but really thinking about, who's going to roll up your sleeves and really be there for you through thick and thin, and really kind of vet your prospects.
Yep. So turn every negative into a positive. So you pitch, imagine how hard this is going to make it for our competitors. Keith?
Yeah, I mean, principally, we're just trying to discern how to continue to open up the access to potential investors and think critically about where the fits are and not just send our founders off on goose chases. So yeah, continue to reevaluate our relationships and where we trust and make those connections so they can get directly to investors.
So last 10 seconds goes to you, Ellaine.
It's really about building on our partnerships with other investors. It's really going, who do you talk to? Who do you know? Sharing the deals, sharing the expertise. Almost all of our deals are syndicated, and really having those close relationships and continuing to build them in this time and focusing our entrepreneurs on the right opportunities rather than blasting the world.
Right. Guys, thank you so much for your time today and sharing your wisdom with our audience. Back to you, Keith.
Thank you, David, and thank all these amazing investor panelists. They really are the best of the best, and they're super kind people. As you can see, they just gave you great advice on how to do a better job finding investments. So look all of them up on LinkedIn. Check out their investment portfolios. And as David always say, reach out with highly qualified information that matters to their investor thesis, and really take time to research them and make sure it's the right fit, and your odds of success go up.